Though. Once you get here, you're 90% there. Okay, we've done it here. We had 40 million in there. We had 20 million in here. So you just wait it. Okay, the last one. We had the cost of equity. We've done the cost of equity. Okay, so what they noticed in this example is they didn't give betas. So what we need to try and figure out is the cost of equity. Is if we haven't got betas, it's going to be quite difficult to estimate them. We don't really have the information. What they do give us is they give us a payout ratio. So they said that the payout was 50%. They give us a net profit of 20, and we've calculated our price previously as 15. No? Price was 30. That's what we did in the first part. So you can see what this information is looking like is we could use a dividend discount model. So remember, this is G naught times 1 plus G over P naught plus G. Also note they said the expected annual growth in dividends is 10%. Great. So we know that they're going to pay out 50% of their net profit in dividends. That means they're going to pay out 10 million. Nice. And there's how many shares? 10 million. Yeah. So the dividends are going to right. Great, we are just about there. Just need to check. Dividend is, it's 10 divided by 2. 10 million is a dividend, you have 10 million shares, 1 dividend per share. Our expected return on equity does come to is 6, 7. Great. I'm going to stop this and come explain now. But let me just, this is our expected return. Then when we do the WACC, if I do that, it doesn't end up to that figure. So let me just quickly come back to that. So what we can do now, remember it's the weight of debt times the cost of debt times 1 minus T plus the weight of equity, cost of equity, plus the weight of preference shares times the cost of preference shares. Okay? And we've kind of worked this all out, and it simply then becomes a plug and play. So we had, there's our figures here, 15% debt, 10% equity, and 75% equity and 10%. So 15% debt, 10% preference shares, and 75% equity. Great. Cost of debt, You can calculate the weighting. I mean, the weighting I came to was around 8.85. Okay, percent. And the tax rate is 40%. This example. 75% times the cost of equity we got 13.67%. 10% times 6.4%. How do we get 6.4%? Quite simply. In the example, they had said that there was that it was we issued at 125 rand, and they were 8%. Equals to 6.4%. That's the cost of your preference shares. Okay, and then that ends up to a whack that comes to around 11.6. Okay, stop for a minute and then I'll come back.